Good day, people. Lamar Jones, Uptown Accounting Group, back at you with another one. This time, we're going to speak about the quarterly earnings of JP Morgan. JP Morgan is the biggest bank in America as it relates to assets. So today, we're going to figure out more about them. This is their press release, and so you can get this through their website, JPMorgan Chase, and they speak about their Q1 2026 financial statements. And so I'm going to go to the earnings presentation and start there. Okay, and just so I'm going to download it. Okay, so I have it downloaded, and I'm going to get things started. Therefore, this will probably just cover the income statement and balance sheet, and they have it at a high level. Uh, but deeper detail is provided in the SEC. So this is a presentation for people. But if you really wanted to get down to the bone gristle, you can go to the financial statements, which is in the SEC database. And so that's where the sourced financial statements are located. Now, just reading this, we can understand income statement Q1 2026. So this is January through March of 2026. Net income of 16.5 billion, managed revenue of 50 billion, expense 26.9 billion. So they brought in 50 billion from revenue, roughly kept 16.5 billion. It's a quick way to look at that. Um, Now, this expense of 26 billion, we'll figure out more about that as well. And I'm curious on what's the difference between, because if you take the 50 minus this expense, that's 24 billion. But they have net income of 16 billion. So there's another like 8 billion somewhere that will probably flush itself out as we go through. Balance sheet, loans. Average loans of 1.5 trillion, up 11% year over year and 2% quarter over quarter. So when you're dealing with the bank, their balance sheet is going to have loans on them, and loans are an asset for them. So when they give out loans, they're able to charge interest, and that's where they make a lot of their money is through interest. So that's why they're reporting that within their balance sheet. So they have loans of 1.5 trillion. So money is given out from this institution, which is JP Morgan, and they're making money off of that. Remember, assets are things you make money off of, and um, JP Morgan is in the business of, and all banks are in the business of making money off of money by way of loaning it out and then making a profit. So deposits, average deposits of 2.6 trillion. So when you're dealing with the bank, they have deposits. So we know we deposit our money, people deposit their money into bank accounts, and the bank classify those as liabilities. Now they're able to take that money and use it for whatever the case may be, such as loaning it out for 1 point. So they could take that 2.6 trillion in deposits and loan out 1.5 trillion in loans if if that's the case. So if that's what they wanted to do. So deposits are 2.6 trillion. So they have more deposits than they do loans, which that's a good thing. So and then the capital one is 291 billion, and that's more of a stress test type of thing, but we may cover that and may not. So we're going to move on to the we're going to go right here. This here shows their revenue of 50.5 billion. And this is in billions, you see? That's why they have B. And so you have to consider what the how is I guess what denomination it's in, and so this is like organized by billion. So if you see this 50 here, that's 50 billion. You see this 3 here, that's 3.8 billion, so on and so forth. Um, so we already talked about managed revenue of 50.5 billion. Now we're about to get into it in detail. So 50.5 billion. Now, JP Morgan, like I said, they're one of the most respected banks in the United States, if not one of the most respected in the world. And their one reason is the fact they make a good amount of money from non-interest revenue. And so a lot of banks are like basically hand tied to interest. They're only making their money from interest. And that's not a good look. And investors don't like that. So they want a bank to be able to make money from things outside of interest. And JP Morgan demonstrates that with 50% of their money coming from interest, 50% coming from non-interest. And um, so out of that 50 billion, 25 billion came by way of interest income. So giving out loans and getting interest on that. And then another 25 billion came by way of non-interest. And you don't want to be hand tied to interest, because if people stop paying their liability or people stop paying their bills, then you won't make that income anymore. And so you're very much hand tied to and dependent on people paying their bills. And so that's why they don't want to do that. So managed revenue, 50.5 billion. Expense of 26.9 billion, which we talked about here. So this is that 26.9. Credit cost of 2.5, and then they have a net income of 16.5. Now that still doesn't add up, and so you probably have to read it. It didn't flush itself out in the numbers, but it's flushed somewhere. I probably won't have the time to do that, but basically we know we have a net income of 16.5 billion out of JP Morgan. And so out of the 50 billion that came in from January through March, 24 billion of it uh, was it 24 billion? Actually, a little bit more than that. And so call it 34 billion. 34 billion of it was spent on expenses. And so 16 billion was left over. And out of that 34 billion in expenses, we understand 28 of it or 29 of it. So it's like 7 billion we don't understand. But we understand like 29 of it. And that is the expense here and the credit cost. So let's keep going. Balance sheet. And these are more so metrics. And so we want to find the actual balance sheet. Okay, maybe we'll find the balance sheet. Not in this presentation deck, but they have it in other decks. If we wanted to go here to supplement, I'll let that load up, come back to it. But in the meantime, we can still go into the businesses. And so we understand that we have a $50 billion revenue with net income of 16.5 billion. Well, you can also see this information within the business. And so JP Morgan has 4 or so distinct businesses. One of them is consumer and community banking. And this is dealing with consumers and banking within the community. You can look here at those businesses at deeper detail. You have banking and wealth management, you have home lending, you have and card services and auto. And so credit cards, that's a big um, interest bearing business. Banking and wealth management is also a big business. And so when you look at that, we have $11 billion in expenses subtracted from this 19.5 billion in revenue. You have credit costs, All of that equals net income of 4.9 billion. And keep in mind, this is in millions here. And so billion looks different than what it looked at when we were looking at it from top of the house. So this is basically that 5 billion. And remember, they had a total net income of 16.5 billion. Yeah, right here. So out of this 16.5 billion, 4.9 billion, let's call it 5 billion. Let's call it 5 billion, came from the consumer and community banking. Now, let's see what other how it breaks down for other businesses. So we got 16.5 billion at the top of the house. Then we have 5 billion from the consumer and community banking business. So we still have some room. Now we have another 10 billion here from this business, and this business is commercial and investment bank. And so they made 10 billion from commercial businesses and investment banks. So when you take a look at that in deeper detail, you can see the total revenue, 23 billion, and you have total payment banking and payments of 10.4 billion as their expense, and then another actually, yeah. So this is how it's broken down with the you have banking, and then you have markets and security services. And so this 10 billion here subtracts from this um actually, okay. Wow, sorry about that. There's 23 billion here. It's broken into two lines of businesses. And so the first business is total banking and payments. They made 10.4 billion. 10.4 billion. The banking and payments. And then you have another business, markets and security services. They made 12.9 billion. So these two businesses make up the commercial and investment bank. So you have two businesses that make up this one big business. And so basically this commercial investment bank, like I said, made 23.4 billion, broken into these two different parts. Then they had expenses of 11.1 billion. So these businesses are very good. The banking and payments, which we should understand that because a lot of payments have changed the way we make payments, and the bank has been a part of that and been able to make money off of that. They're now making money off of, you're making payments from your phone, from your watch, from whatever the case may be. I mean, next you may be able to make it from your eyeball. So, and the bank will make more money off that. So payments is always a big thing for business, for banking businesses, because with every technology change, there's another opportunity for revenue. Investment banking revenue was decent at three billion. When I say decent, relative to JPMorgan. Basically, this is probably some of the most money in the business, but for JPMorgan, it's not their biggest. So that's what I meant. Now, going into the other business that make up commercial and investment bank is markets and security services at this 12.9 billion. This 12.9 billion, biggest thing in that is fixed income markets. And so this is bonds, this is more stable assets. Then you have equity markets, which consist of um, basically stock market stuff. So a lot of derivatives. So they made let's call it 5 billion here. But then they also made, go back to this fixed income, because sometimes currencies and commodities go in here as well. And so they're actually making more money from their fixed income divisions at a tune of 7 billion. Security services, 1.5 billion, and that makes up pretty much the markets and security division. So markets and security is actually making more than banking and payments. And uh, but when you total it all up, this is probably their biggest business. We yet to see, but we know we're dealing with a total top of the house. When I say top of the house, that's from a JP Morgan perspective. This here is at a commercial and investment bank perspective, which is just a business within JP Morgan. When we go top of the house, we had a net income of 16.5 billion. Then we go community banking. We had a net income of 5 billion, and now we have a net income of 19 billion. And so we already dealt with 14 of the 16 billion in net income. So we don't have much left, basically. The next business is asset and wealth management. They made, let's call it 1.8 billion. And then the corporate, which is basically 700 million. So we're dealing with JPMorgan, the biggest bank, in the United States with the most assets, which I have to cover the assets. And I'm going to see if this is, let's just touch on the assets because JPMorgan has the biggest assets. And this is another small document. I would download that real quick. But yeah, when you're dealing with JPMorgan, so the payments and the securities is real big. I mean, basically, um, most of the net income and revenue is by way of fixed income, currencies, commodities, and equity securities. So this is done. All right, all right. Okay, okay. Where we at? Consolidated balance sheets, page 5. See, the government have it to where you can click on that and go to it, but JP Morgan and other corporations, they're like, you got to just scroll down there. All right, this is still small, and so I'm going to make it big. All right, all right, all right. This is in millions. So when you see one on here, just know that means 1 million. If you see 22,000 on here, such as this, just know that means 22 billion. This means 820 billion. This means 4.9 trillion. Huh? 4.9 trillion. So when you're dealing with JP Morgan and their assets, they're the biggest dog on the street with their assets. Here it goes. And you can look at their assets. In March, the end of March of 2025, they had assets of 4.3 trillion. Then it went up to 4.5 trillion. Then stayed a little flat in September. And then even went down a little bit. And then went up majorly. Went up almost $500 billion in a 3-month time period. So this is a major improvement in assets. And so 4.9 trillion in assets. Let's talk about it. What are these assets? Well, remember, assets are things you use to make money. We talked about it. We're going to continue talking about it. So when you look at this 4.9, how would this break down? So one is, let's go up in here. Cash. So 22 billion in cash. Just a drop in the bucket. This is cash due from cash and money that's due from other banks. So they have 4.9 trillion in assets. Only 22 billion is in cash deposits with banks, and so they deposited money into banks. 290 billion worth. That's another asset for them. So this is like cash. So you can say 310 billion in cash. The next thing is federal funds sold and securities purchased under resale agreements. So they purchase securities and they purchase 500 billion in securities. Securities borrowed another 284 billion. And so these are, you could buy securities for different reasons. Some people buy it for to short the market, and so um, that's a whole thing. But basically, these are still securities, and so they have roughly, let's call it 760 billion So almost a trillion in securities on their balance sheet. Um, and when I say securities, I'm only speaking about federal funds. So we have, let's call this 760, and then we have 300. So it's basically a trillion here in federal funds, security, and cash. And then you have other type of securities like trading assets, which they have debt and equity instruments of $1 trillion there. So this is their biggest security in trading assets. And so they have a lot of trading assets, which we would, to go deeper into that, you would want to go to the sec.gov and really find out more about these assets. Even there, still a little gray, but it's still more information than what's provided here, which is to be expected. Available for sale securities. These are securities that um, basically they're ready to sell and they're available for sale. They have another 600 billion in that, and another 272 billion in held to maturity security. These are securities that they're expecting to hold until the security expires. They're not looking to trade or flip that real quick. They're looking to flip this. And so when we add up the, they have 821 here. Now there's credit losses, which is a different thing when you're dealing with banks, where basically they have to forecast a loss based off of um, creditors not paying them, people not paying them. And so a lot of their total figures is actually decreased by this allowance for a loss. With that being said, after the allowance, they have a total of 821 billion. So right underneath a trillion in investment securities. When you could see that really, it really adds up more than that, but they have a credit loss somewhere in here to drop it down to. So this number could well have been over $1 trillion. And then they took $200 billion loss in their projected forecast to get to this 821 billion. So then they have loans, like we spoke about. Loans are assets, and so they've loaned out money, and they've loaned out that money expecting to get interest, and so they have 1.5 trillion in loans, which we discussed already. So 1.5 trillion in loans plus this 821 thousand or 821 billion. Sorry about that. Uh, to get you to, let's say, 2.3 trillion, and then we have another 300 billion to get us to 2.6 trillion. And then I think they're even counting this to get us to, like, let's say 3.2 trillion. And so you have to add the cash, you have to add the federal funds and securities, which is roughly around 760. And then you have to add this 821, and then add this 1.5 trillion. And we still have a little bit more to go, but not a lot. Most of those numbers, if we would just do quick math here, 300, 760, that's a trillion, plus 820, that's 1.8 trillion, plus 1.5 trillion, that's 3.3 trillion. So, uh, so yeah, we still have maybe like 1.4 trillion or 1.6 trillion left. And so, uh, so I would have to go through this in more detail. I just wanted to highlight a few of these things. Some of these times, sometimes you do have to read these items, but most of their assets come by way of securities. So, long story short, that's why JPMorgan is like one of the biggest banks and most respected, because they're heavily involved in the stock market, uh, not just stock market, commodities market, whatever you have, derivative markets. They're heavily involved and have a high amount of market risk. So, uh, the matter of fact, they have the most market risk, I would imagine. So That is the asset line. It's basically a bunch of marketable securities. So if the market was to go in a different direction and they weren't hedged for it properly, they would lose a lot of money. But the thing with JP Morgan, they're known to being great hedgers. So moving on to liabilities. Liabilities, remember when you're dealing with bank, the biggest liability is going to be the deposits. And so people that have deposits within JP Morgan, your money is within this 2.6 trillion. After that 2.6 trillion, we have like 2 more trillion in liabilities to talk about. One of them is federal funds purchased and securities loaned or sold under repurchase agreements. These are securities or loans. If they go bad, JP Morgan has agreed to purchase them. So that's like 716 billion that they have planned to, if anything goes wrong, they'll buy it back. So that's why they have that in their liabilities. If you add that to the 2.6 in deposits, you'll get, let's call it 3.4 trillion. And so that leaves us with basically 1.1 trillion left. And so, and a lot of that is long-term debt. So they don't really discuss what that is, but examples of long-term debt could be mortgage, it could be a license, and so a lot of different things there. Accounts payable and other liabilities, people that they owe 352 billion, and so that's within their liability section. And so most of their liabilities are deposits, but then after deposits, they agreed to buy back some items if they go bad. They also have long-term debt, could be mortgages, and they also have accounts payable where they owe people. So keep it in mind, assets minus liabilities equals equity. They have an equity amount here of 364 billion. And so they have assets of 4.9 trillion, but then when you consider their liabilities and people they have to pay and things that they owe, that's 4.5 trillion. That subtracts from all of these assets that they have to get them equity of 364 million. And so, or 364 billion. And the biggest item here, and I stress this, is retained earnings, which comes by way of your net income. So just to show you this, we have, okay. Now we were looking at the income statement from the presentation deck, but now we're here at the actual in the supplement information, and so maybe I'll go back to the document we had. Yep. And so net income, like so the business made net income of 16.5 billion. Remember, this is 16.5 billion. This is in billions. 16.5 billion. It makes it go, it's a direct input into retained earnings. And if you think about the word retained earnings, it's earnings that you're retaining. It's not blowing the bag, it's keeping the bag and preserving the bag. So you're retaining it. You got the bag in a headlock. Uh, and so that's the retained earnings. You look at JP Morgan, they're retaining earnings. They're not playing any game. They're not getting the money and blowing it. They have 428 billion in retained earnings. So they almost have a $500 billion in retained earnings that they saved throughout the years. So that's most of their equity. Without the retained earnings, this company is not the same, flat out. So we got to, keep that in mind. And so that sums up the balance sheet. So I think we covered, in this video definitely went longer than expected. Uh, we covered the income statement and we covered the balance sheet for JP Morgan. And so hopefully you were able to digest that. If not, let me know. If you have any questions, comment, let me know on the bottom. I'll be sure to get back with you. In the meantime, like, follow, subscribe, all of that. New channel trying to grow. Until next time, deuces.